This video is perfect for any dividend growth focused investors out there that are interested in investing into high quality dividend growth ETFs that offer things like diversification, growth, and dividends that only get bigger and bigger over time. Now, the three ETFs that we are going to break down in this video are going to be the SCHD ETF, DGRO, and one of my new favorites, DGRW. Now, to be honest with you, all three of these ETFs are extremely solid in my opinion, but there's only going to be one winner, which you are going to see towards the end of the video. Now, drop a like down below, subscribe, and let's get right into it. Now, the first dividend growth ETF that we're going to break down out of the three is going to be the Schwab US Dividend Equity ETF, known as SCHD. Now, this ETF's objective is pretty simple. It says the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. And some of the highlights of the ETF: a straightforward low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement a diversified portfolio. Now, SCHD tracks an index focused on quality and sustainability of dividends, and we're going to break down the holdings within all these ETFs in just a minute here. Now, this ETF has performed very well historically over the last 12 or so years. It's up around 171% as far as just ETF price return. But over the last year or so, especially year to date, this ETF has been feeling some pain, down around 5 or 6%. Now, looking a little bit deeper into the holding breakdowns for SCHD, this ETF is mostly made up of industrials at 17.7%, then healthcare, financials, consumer defensive, and technology. And the holding breakdown, of course, is going to be a very important aspect of any ETF that you invest into, because at the end of the day, this is exactly what you're getting exposure to. You're buying into an ETF to get exposure to the holdings within it. Next, the SCHD has a smaller portion of energy, consumer cyclical, communication, basic material, and utility. Now, the top 10 holdings as of right now for SCHD is Amgen, abbvie, Chevron, Merck, PepsiCo, Coca-Cola, Verizon, Texas Instrument, Broadcom, and Pfizer. And all in all, there's around 100 different holdings within this ETF. And all these holdings have a few things in common. They all pay dividends, they're all solid stocks in their own, and they all have a history of raising dividends over time. Now, the expense ratio for SCHD, another important aspect of any ETF that you're going to invest into, is just 0.06%, which makes this ETF very, very affordable to hold on to. Now, lastly, looking at another important metric when it comes to SCHD, dividend yield. The trailing 12-month dividend yield is around 3.69%, but also very important, SCHD does have some massive dividend growth. Over the last 3 years, 11.4% is the dividend growth rate on the 3-year CAGR. Now, the 5 year is 13.69% and the 10-year is 11.11%. So when it comes to this ETF, you're not only getting a nice initial basket of holdings, a nice starting forward dividend yield, but also some massive dividend growth potentially ahead. But now, seeing exactly what DGRO, the next dividend growth ETF, has to offer, and to see if it's better or worse than that of SCHD. So DGRO offers low-cost exposure to US stocks focused on dividend growth, which is one of my favorite aspects of dividend investing in general. Number 2, it says access companies that have a history of sustained dividend growth and that are broadly diversified across industries. Sounds pretty good so far. Now, DGRO on the max time frame is up around 98%, which is pretty impressive. Also, the DGRO ETF is beating the SCHD year to date, only down around 0.5% or so. Now, looking at the DGRO's breakdown of holdings, they have healthcare at almost 20% of the overall ETF. So I repeat, make sure you know exactly what holdings and what sectors make up the ETFs that you buy into, because that's what you're buying exposure to. The next biggest breakdown is financials at 18.5%, then technology, then industrials, consumer defensive, energy, utilities, consumer cyclical, basic material, and communications. Now, DGRO also has a nice solid basket of holdings and over 400 different holdings for DGRO, so it is going to be much more diversified compared to something like SCHD, which, to be honest, some investors like myself actually want more diversification than less. So the top holding of DGRO is currently ExxonMobil at over 3%, then JP Morgan, Microsoft, Johnson & Johnson, Apple, Chevron, abbvie, Pfizer, Procter & Gamble, and the Home Depot. So a few of the same holdings as SCHD, but overall a pretty solid makeup of top 10 holdings, if you ask me. Now, DGRO does have a little bit more of an expense ratio, so that's definitely going to be something to consider. Although at just 0.08%, the expense ratio is still relatively very cheap. Now, DGRO is going to have a 2.56% trailing 12-month dividend yield, which isn't all that bad at all, but the dividend growth for DGRO has been very, very impressive year to date, up over 12%, the last 3 years 8.7%, and the last 5 years over 9%. So DGRO's strategy is to buy into different companies that have a history of growing their dividends, and that's exactly what they've been doing and able to do so far. The last ETF that we're going to go through in the battle of dividend growth ETFs, trying to figure out which one is best, is DGRW, the Wisdom Tree US Quality Dividend Growth Fund. Now it says, why DGRW? Gain access to the current investment landscape of US large cap dividend growing companies by applying quality and growth screens, and use as a complement to high yielding dividend strategies or replacement for large cap quality strategies. Now, DGRW came across my radar as of recently, and I've definitely been interested into it, and you're going to see why in a second. Now, DGRW over the past 10 or 11 years is up around 157%, not even including dividends, and year to date is the only one that's green out of the bunch, up over 5%, which is pretty impressive compared to the others. Now, DGRW is going to have technology at the biggest portion of their entire ETF, at almost 30%. So that means that this ETF compared to the other two is going to have a little bit higher beta, which means that when the market goes green, DGRW is going to move a little bit faster with it, and vice versa when the market goes red. But with technology being almost 30%, then consumer defensive is next, industrials, healthcare, financials, consumer cyclical, basic material, real estate, energy, utilities, and communication. Overall, I really like the sector breakdown, and this is one of the main reasons on why this ETF is really on my radar. Now, the top 10 holdings for DGRW are very, very solid companies. Companies like Microsoft being over 8% of the entire ETF. Then we have Apple, which of course we all love. Johnson & Johnson, Broadcom, Procter & Gamble, the Home Depot, Merck, Cisco, Coca-Cola, and Walmart. Now, DGRW is also, I would say, very diversified with just about 300 different holdings within the ETF. So far, this ETF seems really, really solid. Now, one of the negatives for sure when it comes to DGRW is the expense ratio at 0.28%, which is much, much more expensive than that of DGRO and SCHD put together times 2. And looking at DGRW's dividend, they're offering around a 1.92% trailing 12-month dividend yield with some dividend growth historically. Looking at the dividends over the past, say, 10 or 12 years, you can see that there has been some significant dividend growth over multiple different time frames. So now that we went through all three of these different super powerful high quality dividend growth ETFs, that honestly I am a fan of every single one of them. There's only one thing left to do, to stack up DGRW next to DGRO, next to the SCHD ETF, and look at how they've all performed over multiple different time frames using total return as the metric. So total return is dividends plus price return included. And although moving forward, I think pretty much any of these dividend growth ETFs could be an awesome investment for a long-term investor, this is going to show us exactly which ETF is a true winner. So over the last 6 months, DGRW is the winner at 4.65% total return, then DGRO at 2%, and SCHD is basically flat. Year to date, DGRW is crushing both DGRO and SCHD. DGRW almost 7% in the green, DGRO 1.25% in the green, and the SCHD ETF minus 3.35%. Now, over the last 365 days, 18.3% DGRO, 14.07%, and the SCHD ETF 9.07%. So honestly, all three of these did pretty well over the last 365 days, relatively speaking, but DGRW is still the winner. Now in the 3-year time frame, this is where things change. SCHD is the winner at 42.45%. Next is DGRW, and last is DGRO. So a little bit more stretched out, 3 years, 1,095 days, the SCHD ETF pulls ahead and wins. Now over the last 5 years, the longest time frame that we have to go off for a year, the DGRW ETF has a 58.93% return, making it the all-out winner, and the DGRW ETF has won on multiple different time frames. Number 2, right behind it by a sliver, is the SCHD ETF at 57.66%, and then DGRO at 50.31%. So even though, as you can see from the chart, they all trade pretty close to each other over multiple different time frames, just as of recently, maybe just as of the last 6 months or so, the DGRW ETF has officially pulled ahead to make it the official winner out of these three. So there we have it. Those are three of maybe what I think are the highest quality dividend growth ETFs across the entire market. But now I want to hear from you guys down below if you could only hold on to either DGRW, DGRO, or SCHD forever. Which ETF would you hold on to and why? Comment down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.